A stock market crash occurs when stock prices drop significantly across a comprehensive portion of the market, resulting in substantial paper capital loss. Panic selling and underlying economic conditions cause crashes. They often accompany speculation and financial bubbles. A stock market crash is a social phenomenon that happens when external economic events combine with crowd psychology to create a positive feedback loop. Some market participants sell, causing more market participants to sell. Around once every 1.84 years, the stock market has corrected or fallen by 10% or more since 1950. So it's no longer a case of if, but when the stock market will collapse again. Taking the steps below now will assist you in weathering the next inevitable storm. Don't forget to subscribe to the Stock Monster for more riveting material if you want to stay up to date with the new inspiration to grow financially. Stay with us with only one click on the bell icon. Let's begin with the 10 tips on how to prepare for a stock market crash. Number 1. Hoard cash in a savings account. In a stock market crash, people lose money if they sell at a loss. However, if they don't have enough cash on hand, a job loss or an unexpected high cost can leave them with no choice but to raid investments that have already tanked. Ideally, you can have 6 months' worth of living expenses stashed away in a bank account or CD. If they receive a 401k business match, they can continue contributing to receive the maximum payout when creating their rainy day fund. However, until others have enough emergency funds, you should strongly consider deferring other investments. As the economic crisis continues to reverberate around the world, a growing number of Americans are devoting time to learning how to manage their finances better. Building an emergency fund is at the top of the list. In reality, according to a recent MassMutual poll, more than 1/5 of Americans, about 22%, saved at least $1,000 during the pandemic this summer. Although maintaining a reliable savings account is necessary for a secure financial future, committed savers should be mindful that there is such a thing as too much money saved. Number 2. Create a budget for your stock watch list. Not everyone can stomach bringing more money into the stock market after it has collapsed. Create a stock watch list and set aside extra cash in a savings account if someone has a high risk tolerance, a big emergency fund, and no credit card debt. This way, he can buy after rates have dropped. The critical thing to remember is that these are stocks that you'd like to buy even if the market hadn't just collapsed. A lousy business that you purchased cheaply is still a bad business. To create a stock watch list, the individual will need to set aside money. Understanding our modern market climate, how different levels of capitalization influence price growth, and how other sectors respond to catalysts over time are all necessary for a well-organized watch list. When choosing candidates to pursue regularly, weekly, or monthly, consider seasonality, sentiment, and economic cycles. Number 3. Make sure you're not too reliant on a single industry. Some stock investors, according to experts, may be in danger of losing their money. The S&P 500's top 10 stocks are mainly tech stocks, accounting for 27% of the index's weighting. There's no need to sell the winners because of this. However, if anyone has extra capital to invest, he might want to diversify his portfolio by adding some defensive stocks, which are more resilient even during a bear market. Market staples and service stocks are good examples of consistent demand regardless of the economic cycle. Particularly for professionals, stock trading is a risky proposition. The gap in the economy versus the rest of the world seems to have widened in the last year. Stocks rose as the COVID-19 pandemic wreaked havoc on the economy, resulting in record unemployment and 400,000 deaths in the United States. As a consequence, people should shield themselves from being overexposed. Number 4. In 5 years, sell any stocks you don't want to buy. If you have stocks you've meant to sell, don't wait for the right moment. Sell them now. People shouldn't make this decision simply because they are concerned about a stock market collapse. However, if you have a stock in a company that is losing its competitive edge or no longer suits your investment thesis, you should sell it while the demand is still high. If they want to cash out, the same rules apply. If people anticipate having capital in the next 5 years, they should stop investing in stocks. The ability to benefit from stocks, in principle, requires two significant decisions: purchasing at the right time and selling at the right time. It would help if you correctly executed both of these decisions to make a profit. The purchase price decides the return on every investment first. Number 5. Don't invest in the margin. Margin trading has a more significant profit opportunity than conventional trading, but it also comes with a higher degree of risk. The consequences of losses compound when purchasing stocks on margin. A margin call, which allows someone to liquidate their stock position or front more money to retain their investment, can also be provided by the broker. People use margin to borrow money from their broker to spend more money. We value your enthusiasm, so don't forget to subscribe to Stock Monster's YouTube channel and ring the bell to be informed of new episodes. And keep watching. Number 6. Build your asset allocation with the full expectation of a 20% to 30% market decline. Many investors began to see the stock market as a position where annual asset prices only rose after a decade or more of gains. In 2009, when they emerged from the previous downturn, they had many cautionary discussions with investors. Still, by 2019, the bulk of those conversations has shifted to hope, and greed inevitably replaces terror, as the old saying goes. Of course, if they are a long-term investor willing to accept the significant risk of loss that comes with investing in stocks, they should consider an all-stock portfolio. Please view their true risk tolerance and how they will possibly respond to a downturn before they do. Number 7. Use pound cost averaging. Investing every month can help eliminate the market timing problem, but for those who have a lump sum now, spreading out their investment over some time, such as the next 4 quarters, rather than in one lump sum, will help them deal with the issue. If the market's correct, at the very least, they don't lose any of your money. And if the markets continue to grow, at the very least, they got some money going right away. This approach focuses on handling your investing feelings rather than the result, as it helps you escape the disappointment that may follow a one-time decision that goes against you. Number 8. Decide how many risks you need or want to take. Danger and reward are inextricably related. High risk holds the potential for high returns, but it also carries the risk of substantial losses regularly, and vice versa. The amount of risk a person is willing to take is entirely up to him, but if he is young and still building up his assets, he will have more time to recover from setbacks. If he is older and has already accumulated sufficient wealth, he may want to lower his risk of loss to avoid drawdowns that he may not have time to recover from. Reassess the risk that he is currently taking to make sure that it is consistent with his needs. Number 9. Examine the quality of your bond portfolio. During the recent downturn, investors discovered that not all bonds are equal in terms of security. That's because high-yield bonds, also known as junk bonds, have a clear correlation with stocks, and when the chips are down, these assets frequently perform poorly. Although high-quality investment-grade bonds may appear dull during a risk-on period, they may seem far more appealing as the story deteriorates, created on equal footing. A 50% stock and 50% bond allocation, for example, can provide comfort. However, there may be little or no if the bond category is overweight in high-yielding, lower-quality bonds. Number 10. Read up on past stock market crashes. History informs us that another stock market crisis is on the way, but that a rebound will inevitably follow it. The most important thing for everyone to remember is that stock market crashes are frequent. Even if the market plummeted today, people would still have a 73% chance of making a profit if they invested in the S&P 500 in a given year. Over 5 years, their odds rise to 87%. Over 10 years, the chances are 94%. And at no point in history would they have lost money by investing in the S&P 500 for 20 years. The lesson is to remain calm and stop making rash decisions. These were the top 10 tips on how to prepare for a stock market crash. Make sure to leave a like and subscribe so you can join the Stock Monster squad and be a part of the channel. Thanks for watching!